In this chapter, we're dealing with the analysis and interpretation of financial statements. This really wraps up all of the discussions we've had about the financial statements, all of the different components of the accounting, and now we're going to look at how an outside party, whether it be an investor or a financial analyst, would look at this information and determine how well a company was doing. So we're going to bring these building blocks of analysis back up later on. But for right now, we're going to look at liquidity and efficiency. We're going to just go through them. Liquidity and efficiency deals with short term. So how well are they able to pay their current bills? So we talk about the current ratio, the quick ratio, and efficiency. How efficiently are they operating? For solvency, it's much the same except we're dealing with long term. So are they going to be able to continue into the long term, generate profit long term, and pay off their long term liabilities? For profitability and market prospects, they're going to be very similar, but profitability we're talking about from the investor's perspective, is this company profitable? So gross profit, all those ratios there that we deal with there. Being profitable is important because it allows the company to attract and retain financing. Market prospects, these are certain key indicators that investors want to know about. They use those to measure how well the company is doing. So first of all, we see all this analysis. What are we comparing against? We have to take a look at intra-company comparisons, which basically means we're comparing this year to the prior year of our own company, or we're comparing Department A to Department B within our own company. Competitor analysis means that we're comparing against our major competitor, our main major competitor. Industry analysis is similar, except we're comparing multiple competitors. Guidelines, these are rules of thumb that you have to be careful when you're using because your industry may be a little different than the general rule of thumb. For a quick example, we'll see this later on. The current ratio, the general rule of thumb is that 2.0 is a good current ratio. 1.0 would be a good quick ratio. But that may differ depending on what company you're in or what industry you're in. So for the tools of analysis that we're going to use, here are the main terms. We're going to see a few different terms for these, descriptions of these. Horizontal analysis means we're comparing across time, across the time horizon, this year to last year, and maybe even multiple years. Vertical analysis is we're comparing within 1 year, we're comparing various pieces to some total amount. Ratio analysis is what we've been talking about up to this point in all the other sections. We're comparing various ratios, the quick ratio, the current ratio, debt to equity ratio. This is within 1 year, within one company, but certain key items that should have a relationship. So let's look at the horizontal analysis first. We're looking at comparative statements, multiple year statements to get this information. The first thing we need to do is compare the dollars themselves. Take your analysis period amount, in other words, your current year, minus your base period amount, in this case, your prior year. If you're just dealing with 2 years, it's basically current minus prior year. Once you get your dollar change, you can calculate a percentage change by taking that dollar change divided by the base period amount, the prior year. You want a percentage, so you multiply it by 100. Here's an example. With cash and equivalents, notice we have 2010 and 2011. We take the $23,500 minus the $12,000 for the next year's cash. We get a decrease of $11,500, which if you take that decrease divided by $23,500, the base period amount, you find you have 48.9% decrease. You can do that for every single line item on that statement. You can do the exact same thing for the income statement. Current minus prior, and then take your dollar change divided by the prior. With trend analysis, we're doing the same thing, only we're spreading it out over multiple years. We're not just comparing current minus prior, we're comparing 3, 4, 5 years. So we take the analysis period amount, which is no longer just current year. This is going to change as we move on to each later year. and then we're going to divide by the base period amount, which will always remain the same. It's going to be some earliest year. And then again, since we want a percentage, you multiply it by 100. So 2007 is going to be the base period in this example. Each of these will be an analysis period to get the percentage for that particular period. In 2007, obviously, taking that number divided by itself is going to be 100%. But in 2008, we'll take 290,000 divided by 275,000. We find out there's 105%. It's 105% of the base period. That's how we should say it. You do the same thing for each line and each year. The key thing, though, is we're always comparing back to 2007. So for 2009's ratio, we take 320,000 divided all the way back to 275,000. Now we have 116% over that 2007 amount. Because of the way this is done, each year should get significantly higher and higher. The whole purpose of trend analysis is to allow us to graph this so we can see it visually what's going on here. And it's easier to kind of understand things when you see it this way as opposed to just comparing numbers. So here you see the gross profit was pretty healthy up to 2008, well above your revenues and cost of sales. From 2008 and on, you can see that the revenues, yes, they increased, but the cost of sales increased even more. So your gross profit slowed way down. Now we're going to move on to vertical analysis, and the term they're using here is common size statements. The whole point of vertical analysis is so that we can compare this year, all the pieces of this year, to all the pieces of some other year, even if there was a major change, like we've opened up a brand new division, maybe we've doubled in size. When those things happen, you can't just take your dollar amounts and compare them because they are no longer comparable. You would expect if you double in size that all of your expenses probably would double, all of your revenues hopefully would double, so it makes no sense to compare the dollars from one year to the next. Instead, we want to get a percentage of a total for each year and compare it. Now that'll make more sense when we see this example here. But what we have to look at first is the base amounts we're going to use. For the balance sheet, we're going to compare every piece of the balance sheet to total assets to find out what percent of the total was that line. For the income statement, it's always going to be compared to revenues. The percentage, it's going to be the analysis amount, which is whatever line item we're currently dealing with, and we're going to divide that by the base amount, which is one of these two items. Again, we want a percentage, so we multiply it by 100. So what we have here for the balance sheet is we're comparing each of those items. Notice we have 2010 and then 2011, so we decreased. I'm sorry, that was horizontal. We're looking at vertical analysis. So even though they give us two different years, we have to look at each year individually. What they're doing is mixing two concepts together. They're mixing vertical analysis and horizontal analysis together here, but we have to start with vertical. So with vertical analysis, we're looking at each piece divided by the total, which is total assets. So 23,500 for the cash divided by 289,700, multiply it by 100, and you get 8.1%. In other words, cash is 8.1% of our total assets. The next year, 2011, you can do the same thing. 12,000 cash divided by 315,000 total assets. That year, cash was 3.8% of the total assets. You do that for each individual line, always comparing to total assets, which are obviously going to be 100% of themselves, and you're good to go there. Liabilities and equity, it's the same thing. You can either compare it to total assets, which is the number we set as the base amount, but you'll find that total liabilities and shareholders' equity, it's the same number. So if you want to use that, since you're on this sheet, if you want to use that instead, that's perfectly fine. Now what you can do, now that you've done the vertical analysis and got the percentages, Now you can compare those two percentages through the years and see how it increases or decreases and why. The income statement, it's the exact same thing except that we're comparing everything to revenues. So for example, our cost of sales for 2011 was 69.2% of our total revenues. Our net income was only 3.4% of the total revenues. With vertical analysis, it makes more sense to use a pie chart type setup to compare everything for the visual representation. Here you'll see this big piece of the pie was cost of sales. The next biggest was selling and administrative. Then we had several smaller pieces. Now we get into the ratio analysis where we bring back those building blocks, the liquidity and efficiency, solvency, profitability, and market prospects. We're going to compare each of the ratios, or we're going to categorize each of the ratios into these building blocks. This just tells us what information we need. We need information from the balance sheet, from the income statement, and now we'll go through the actual ratios. First of all, we have the current ratio. Now, these are all the liquidity and efficiency ratios. So short-term ratios, including current and acid test ratios. And then we have our efficiency ratios, including the accounts receivable turnover, total asset turnover, inventory turnover, and then two ratios that relate to accounts receivable and inventory, days sales uncollected and days sales in inventory. These last five deal with how efficiently is the company operating. How efficiently are they using their assets in their operations? So notice that those turnover ratios, if you recall when we talked about those ratios, they need an average amount. So to get the average, you look at the beginning of the year plus the end of the year, divide it by 2. So that's really what we're doing here. We're getting all that information about beginning and ending of the year. Working capital is our first item we're going to calculate. This is a number. This is not a ratio per se. It's an amount. So here we take the current assets minus the current liabilities to basically tell us how much extra cash do we have on hand after considering what we need to pay off in the very near future. That's all this ratio does. The current ratio, it's the same components, current assets and current liabilities. The only difference is now we're dividing them. Current assets divided by current liabilities. Here we get a 1.55. As long as it's above 1, that tells us we have enough current liabilities or enough current assets to pay off our current liabilities. The question is how much further above and beyond that do we have? Here it's 1.55, so we're 2 is the rule of thumb. So we're fairly close. You'd have to look at the industry this company operated in to really determine how well they were doing. Now we have the asset test ratio. It's very similar, except that now we're dealing with only a subset of our current assets. We're not dealing with all of them. We're just dealing with the ones that we can quickly convert to cash with little risk. So the current ratio, or the current assets that are not included in this asset test ratio, are inventories and prepaid expenses. The thought behind this is that with inventory it may be obsolete, may be damaged, we may no longer be able to sell it for some reason. And prepaid expenses, once you've paid insurance or rent in advance, it's unlikely that you're going to be able to ask your landlord or insurance company for a refund. You're just going to have to use the benefit. So the next ratio we have here is the accounts receivable turnover ratio. This ratio tells us how efficiently are we using, or how efficiently are we collecting our accounts. So we know that accounts receivable, the fact that we allow customers to pay on account, that helps us generate more sales. By giving customers a flexible options, we're getting more sales. But we need to make sure we collect them. So this, we take net sales divided by average accounts receivables. And here in this example, we'll find we get 26.7 times. What this basically means is that we sold a product on account, we collected those accounts, we sold it some more, we collected some more, sold again, collected again, 26.7 times on average throughout the company's year. That's all that's telling us. The higher, the better, the more efficiently we're operating. Inventory turnover ratio. This is the one turnover ratio where we don't use sales. Instead, we use cost of goods sold. The reason for that is that inventory directly relates to cost of goods sold. They're both reported at cost, not selling price, but cost. Again, we're dividing cost of goods sold by an average inventory. The same thing holds true. The way to think about this is that we start off with an empty shelf, we fill that shelf up, we sell it, we fill it up again, we sell it all, fill it up again. We do all that 12.73 times throughout this company's life, or throughout this company's year, on average again. Day sales uncollected. Here we're trying to figure out on average, how long does it take, on average, how long does it take us to collect the accounts? So we take our average accounts receivable, this is just the ending balance of accounts receivable divided by net sales, multiply it by the number of days in the year, 365 days. This will convert it to a day figure. And in this case, we find 14.8 days. So on average, it takes us about 14.8 days to collect these accounts receivables. Obviously, the shorter, the better. Day sales and inventory. What this tells us is it tells us a couple things. It tells us how efficiently we're using our inventory. Are we holding too much inventory on hand? But the other way of thinking about this is if we all of a sudden stopped getting new inventory, nothing else came in the door, on average, how many days could we still sell product before we ran out? So here in this case, it's ending inventory divided by cost of goods sold, but you multiply it by the number of days in the year, 365, again, to convert it to a day figure. Here we have 31.29 days. This tells us that we could stop getting inventory and we'd still be able to sell product for 31 days before we ran out. Now, you don't want too high of a number because that means you have way too much on hand. There's a lot of costs associated with that, a lot of risk. But on the other hand, if you're down to a 1 or 2 day ratio, there might be a risk because if for some reason there's, let's say, a big snowstorm, your trucks can't get to you, you can no longer sell inventory. You're going to be out in a day or two. So that's the concern on the other side. Total asset turnover ratio. Here we're talking about how efficiently the company is using all of their assets to generate sales. So net sales divided by average total assets. This number you could expect to be much smaller because we're dealing with a lot of assets, 1.53 times. You'd have to look at your particular industry and your history to determine whether that number is good or not. Some companies require a lot of asset investment, a lot of equipment, a lot of buildings. Others don't require much at all, and they're able to generate a lot of sales. Now we get to our long-term solvency type ratios, and we're actually going to look at 3 of them out of this group. The debt ratio, the equity ratio. We're going to skip this one, pledged assets to secured liabilities. This one was not talked about in the earlier sections. It's just it's a longer term ratio. So if a company was interested in publishing this or if an investor was interested in using this, they would have that information. Times interest earned, we've talked about, and we'll bring it up again here. It's all about the long-term risk of this company. So we're going to need some information to calculate these. We need net income before interest, expense, and income taxes. You may recall that was from the times interest earned ratio. We need interest expense by itself, total shareholders' equity, total liabilities, and total assets. The first one we have here is the debt ratio. Debt divided by assets. Total liabilities divided by total assets. Out of all the assets we have, what percentage of them are claimed by creditors? So if we go out of business, what percent of them would be used to pay off our creditors? 32.3%. You don't want it to be too high because there's too much risk, But on the other hand, if it's too low, that means you may be missing out on advantages for relatively inexpensive financing. Equity ratio, that's the exact opposite. We're comparing the equity to the total assets. Out of all of our assets, how many were comprised of equity financing? How many of them were financed by equity? 67.7%. So now we can compare debt to equity. Total liabilities or debt divided by total equity. 32%. So this is just a comparison. Obviously, the more liabilities you have as a compared with equity, the higher this percentage is going to be. So the higher this ratio is, there's generally a little bit more risk. Times interest earned. This is another risk-based ratio. Investors want to know how sure are you that you're going to be able to pay your interest off. That's the main concern. They hope you're going to be able to pay the principal off and all your other expenses, but they're very concerned with getting their interest. So you take your net income before interest expense and income taxes. In other words, after reversing the effect of interest expense and income taxes, what was your income? And you divide it by interest expense by itself. So here we get 11.51 as our factor. What this basically means is not only are we able to pay our interest expense off, we have 11.51 times as much as we need to pay our interest expense off. The higher, the less risk. Now we'll move on to our profitability ratios. We're going to look at profit margin, gross margin or gross profit margin, return on total assets, return as a profitability. We could look at return on common stockholders' equity. We're not going to focus on that one here, or book value per common share, but we are going to spend time on basic earnings per share. So we need this information for profitability. We need to know how many shares do we have outstanding throughout the year, earnings per share, net income, shareholders' equity beginning and ending because we're calculating an average, revenues, cost of sales or cost of goods sold, and then our beginning and ending assets. Profit margin. We're talking about net income or net profit. Out of every sales dollar, how much was net income? How much was left for net income after paying off all of our expenses? So we take net income divided by net sales, and in this case we get 10.87%. How able are we to earn net income from sales? The higher the better, but also the higher the more likely you are to have competition. The gross margin or gross profit margin, the gross margin and gross profit, those terms are the same. So gross margin ratio or gross profit ratio, they mean the same thing. So the first thing we're doing is comparing gross profit, net sales divided by cost of sales or cost of goods sold. That gives us our gross profit, which is also gross margin. We divide it by net sales to get a percent. Out of every sales dollar, how much of that was gross profit? 71.66% in this example. Return on total assets. So we have all of our assets that we're able to use throughout this year. How much net income did we generate out of those total assets? It's an average total assets, so we take beginning plus ending divided by 2. Here we get 16.61%. Return on total assets is also referred to as return on investment. A lot of times you'll hear ROI, return on investment. This is the same calculation for that. Now we have basic earnings per share. We're jumping to that one. We're talking about the common stockholders' earnings per share. So we take net income, and then we subtract out preferred dividends that aren't going to be able to be paid out to common shareholders. These are for the preferred shareholders only. So this is basically the net income that's left for the common shareholders to share in. We divide it by the weighted average common shares outstanding. Now, in this example, we basically said we had 27,400 shares that were outstanding throughout the year. In many companies, that's going to be what it is. You're going to have a certain number of shares just outstanding all the year. The weighted average portion means that you have to average it, you have to weight it based on the percentage of the year that that particular number of shares was outstanding. So if you have some of the shares that were only there for 50% of the year, they would be weighted at 50%. Then if you have other shares that were there 100% of the time, they'd be weighted at 100%. In this case, it's $1.96 per share. In other words, if this company was to pay out all of their net income in dividends, so they didn't retain anything, this is what the common shareholder would expect to get. And the last few ratios we have here deal with the market prospects. So we already dealt with earnings per share, so we're bringing that over because we need that amount, but we also need market price and annual dividend per share. So this next ratio, the price-earnings ratio, compares our price to the earnings per share. So market price per common share divided by earnings per share. Here we're saying that we're paying 7.65 times as much as this stock is earning us back as far as shares. The reason we're doing that is that we see more opportunity for growth. We see more potential for this company. We expect earnings per share to jump in the later years, and we expect it to be there for several years. And the last one we have is dividend yield. So a dividend is the way an investor gets their return throughout the year rather than waiting until the very end when they sell that stock. That would be their long-term return. So with the dividend yield, we're comparing dividends, cash dividends, annually divided by the market price per share. We get an annual rate, basically, a return rate. 13.3%. This just tells us here's our return just through dividends. Not our long-term return. Hopefully we sell the stock for more than it's worth today. That'll be our long-term return. But we also like to have a short-term, a current return as well. That takes us to the end of this particular section. I thank you for your time, and hopefully this information has helped to really help you to understand how all the ratios, how an analyst would analyze financial statements, how an investor would analyze financial statements for a particular company. Thanks again for your time.